Hi, I'm Richard Murphy, and this is the 21st in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we are looking at how to prevent the abuse of tax law. We have already discussed the problems that all tax authorities have when facing the reality that many people in all jurisdictions around the world try to evade their responsibility to declare and pay the tax liabilities that they owe. And I have also discussed many of the methods that might be used to identify those who might be trying to do so. We have also discussed the problems that the shadow economy, in which many people on very low incomes are engaged in many economies, might create for a tax authority and how that impacts a jurisdiction's tax strategy. In this video, we address another issue that all jurisdictions face, which is that of tax avoidance. Tax avoidance can be a difficult concept to understand. Some people claim that any action that a taxpayer might take that might reduce their tax liability represents tax avoidance. We disagree. A person claiming a reduction in their tax liability as a result of qualifying for an allowance, relief, or exemption provided for in law cannot be avoiding tax, since they are doing something that a government specifically permits. This is not something that a tax authority should be trying to stop. It should instead be encouraging people to make use of the allowances and reliefs provided for in law and be providing the information needed to help them do so. This is part of the tax transparency agenda. Tax avoidance usually entails setting up artificial transactions or entities to recharacterize the nature, recipient, or timing of payments. Where the entity is located or the transaction is routed through another country, it is international avoidance. Special, complex schemes are often created purely for this purpose. Since avoidance often involves the concealment of information, and it is hard to prove intention or deliberate deception, the dividing line between tax avoidance and tax evasion is often unclear. The best way to explain when tax compliance moves on to become tax planning and then becomes tax avoidance before shifting into tax evasion is to use a chart first developed by UK-based tax barrister Claire Quentin. They suggested that this diagram be used for this purpose. The assumption is that tax compliance, tax planning, tax avoidance, and tax evasion all take place with the assistance of a financial advisor. The advisor initially meets the client when they are at the point A, midway on the y-axis, as shown here. What this implies is that the client is not tax compliant due to their ignorance of the requirements of tax law. As a result, they are undertaking transactions in ways that expose them to unnecessary tax risk. In that case, the tax advisor can contribute significantly to the well-being of both the taxpayer and the tax authority by advising their client on how to become tax compliant. By doing so, the tax professional can add real value to society, which is something that is rarely said. The result is that the taxpayer moves from position A to position B on the chart. The tax advisor can then point out ways in which the taxpayer might entirely legitimately reduce their tax bill by making use of tax reliefs, allowances, and exemptions provided for by tax law. This will require that they reorganize their affairs in some way to secure these benefits. They might, for example, claim permitted expenses of which they were unaware, but which they must now record. Save in ways that reduce their tax bill. For example, many states provide tax relief on contributions to pension funds. Incorporate their businesses and reduce their tax bills as a result, if that is possible where they reside. Other options will no doubt be available. By making use of these options, the taxpayer can move to position C and still enjoy absolute certainty with regard to their affairs. They are operating wholly within the law, but their tax bill might have reduced, as indicated by their move along the x-axis of the chart. The taxpayer might then go further. They can move down the slope from C to D on the chart. Doing so, they might reduce their tax bill, but at the same time, the amount of risk implicit in the tax arrangements that they use, and the chance that they might, as a result, be challenged by the tax authority, increases the further along this scale that they go. The taxpayer also faces the risk that if they seek to disguise the true nature of the transactions that they are undertaking to reduce the risk of a tax inquiry arising, the greater is the chance that their activities cease to be considered as tax avoidance and instead become tax evasion. That is because deception will, in that case, have become a component in their tax declarations, and that is likely to be in breach of the law of any jurisdiction. The point where transactions move from being considered as tax avoidance into being tax evasion is always subjective and will depend upon the intention of the taxpayer, the intention of their tax advisor, the way in which the transaction was constructed and then disclosed for tax purposes, and the attitude of the tax authority on these matters. That such a point can be reached is, however, obvious, and is the cause of a great many tax audits or investigations in jurisdictions around the world. The goal of a tax authority, when it comes to tax avoidance, is to try to prevent, as far as possible, a taxpayer undertaking transactions that might involve tax risk, meaning that they are somewhere on the line between points C and D on this chart. There are a range of measures that the tax authority of a jurisdiction can adopt to achieve this goal. These include the use of general anti-avoidance rules, the use of general anti-avoidance principles, the use of targeted anti-avoidance rules, and arrangements requiring the disclosure of tax avoidance schemes to tax authorities. A general anti-avoidance rule seeks to tackle those who try to break the rules of taxation through the use of further rules that are intended to stop that abuse. Rather than considering intention, a general anti-avoidance rule lays down ways of interpreting a series of events to determine whether the benefits of tax legislation can be given to the taxpayer. The problem with such provisions is that all rules are invariably open to interpretation, including general anti-avoidance rules. As such, they run the risk of increasing the opportunity for tax abuse rather than reducing it. A general anti-avoidance principle differs from a general anti-avoidance rule. A general anti-avoidance principle seeks to prevent a taxpayer from obtaining the taxation benefit arising from any transaction if it was likely that they undertook it solely or mainly to obtain a tax benefit. It does so by looking at the motivation of the taxpayer at the time of entering into the transaction, which is usually determined by the likelihood of any tax advantageous step in a transaction having a commercial explanation. If a commercial motive for each step in a transaction can be shown to exist, then it is likely that the person undertaking it will secure the tax benefit inherent in the transaction. If no such motive can be found, then the tax benefits that they are claiming are unlikely to be available. The effectiveness of a general anti-avoidance principle depends on its careful use by a tax authority. If it uses it too often and loses too many legal cases as a consequence, the threat implicit within such a principle is diminished. If it is used sparingly but successfully, the threat implicit in it can be very effective in deterring complex tax avoidance, including that by multinational corporations. Targeted anti-abuse rules only differ from general anti-abuse rules by being focused on specific forms of abuse, usually in high-risk sectors. These vary from general anti-avoidance rules by only addressing specific issues of concern. Their advantage is that because they are used to address those specific issues, they can be more effective in preventing abuse. This explains their more widespread use. Measures to tackle generic tax avoidance activity vary, but one of the more effective arrangements is one that is focused on the activities of those professional advisors, whether they be lawyers, accountants, or other commercial operators, who create tax avoidance schemes for sale to their clients. In the UK, these are called Disclosure of Tax Avoidance Scheme, or DOTAS rules. These require any advisor that sells a tax arrangement that might reduce a person's tax bill other than in a way clearly provided for in tax legislation must register the scheme that they are selling with the tax authority, and any taxpayer making use of it must then disclose the fact. As ever, when considering these issues, a tax authority that wishes to tackle the tax avoidance must include its plans for doing so in its tax strategy, consult on its planned arrangements, publicise the schemes it has adopted, and also publicise those who have fallen foul of such arrangements to provide a disincentive effect. Like so much else about good tax management, transparency is key to beating tax avoidance.